What's the biggest mistake you see property newbies make and how can we avoid it? Hi guys, welcome back to my channel. I hope you're all good. I'm joined today by Josh, who is a property tax accountant.
Yeah, pleased to be here.
Thank you. Welcome to the channel. So I asked you guys to send in some questions for Josh, who is a property tax specialist. So we're just going to go through those now. So first one, how soon do I need to speak to an accountant when I start investing in property or doing rent to rent?
Yeah, absolutely. It's a great question. For this, I'd always say as soon as possible. When you're setting up and scaling a business, it's hard enough as it is running all the different tasks you've got to do, and having your bookkeeping and financial management as an extra one of those is just another headache. So rather than kind of thinking, I don't want to pay an accountant now, I'd say just bite the bullet, pay it now, because when you've got one or two properties, it's going to be a lot more kind of effort and hard work to get all your finances up to date, to implement the right system, and get that kind of implemented at a later date.
Yeah.
So for that reason, get an accountant as soon as possible, so you're getting the right advice and you've got the right systems, and that way you really are in a strong position to drive your business forward.
Yeah, and it's just kind of like all done properly from the start.
That's it. If you've just got a property and you get your keys, but you don't even know how you're going to record all your income and expenses, and you've still got a kind of a shoebox with receipts, you don't really know where you are.
Yeah, so as soon as possible. So, should I buy property in my own name or a company? Why or why not?
Yeah, so this all stems around the changes to the mortgage interest relief that has really ignited this as a hot topic at the moment. So it really depends on your own circumstances. Broadly at the moment, if you're a higher rate taxpayer, you're going to be penalised by the changes, which result in a lot of people moving it over to limited companies where you're going to pay a bit less tax. But ultimately it depends down to where you want to get to. So if you do only want one or two properties or a very small portfolio and have total income of around £50,000 and that's what you're aiming for, that's fine, keep it in your own name. But if you do want to grow a significant property portfolio, so to pass down to the generations and create long-term wealth, that's when having a limited company structure in place will likely be better from a tax perspective as you get more properties and scale. And
are property limited companies something that people can set up on their own?
Well, it depends. Yes, they can. So you could go set up yourself, but whether that's the right way to do it depends on your circumstances. A specific example of this would be husband and wife. They're both starting their property journey together. They've got money to invest, but the husband maybe earns £100,000 a year, whereas the wife earns no income, stays at home, or whatever it may be. Having the company set up in a beneficial way, something called alphabet shares, will actually give you flexibility to pay different dividends to each of the shareholders. And you couldn't do this by yourself, so you wouldn't need an accountant or a solicitor to do this for you. So it's a question of whether you think this is the case, and then if that is, then you need to speak to an accountant to do it, otherwise do it yourself.
Okay. And do you need to set up a different company for every property you buy?
No, absolutely not, unless there's a valid reason to do so. So if you're buying I suppose it goes by themes, so if you're buying commercial properties, that might be better to keep away from residential properties because there's slightly different taxes. If you're buying service accommodation, that would make sense to keep separated. To give you an example, if you're buying HMOs and service accommodation, there's a lot of valuable tax reliefs available, such as rollover relief, entrepreneurs relief, and ultimately these will result in you paying a lot less tax. But for a HMO company, there's next to no valuable reliefs available, so it would be best to separate them, because if they were mixed, you might lose out on the relief entirely.
Okay, next question. What's the most tax efficient way to acquire properties in my company? Loan to the company using my own money, or mortgage, or joint venture?
Yeah, absolutely. So in that, it's going to be a mix of all of those. So whether you're doing a joint venture, tax doesn't really play a part in that. So if you've got someone who's willing to provide funds on a joint venture basis, don't let tax implicate that decision. It's a commercial decision that based on whether you like that person, you trust them, and they're looking to work how you want to work. But in terms of putting money into the company or a mortgage, it's likely to be a mix of those. So from a tax point of view, you'll probably put in 25% of your own funds as an initial deposit. You'll loan those to the company, and you can charge interest on that, which is tax deductible in the company, but taxable on yourself. So if you've got income under £50,000, you'll receive corporation tax relief at 19%, and then pay 20% tax personally. So overall, on that extra income you're bringing out, you're only paying 1% tax, which isn't too bad. And then the mortgages, that's fine. If it's a limited company, it's a fully tax deductible expense on the mortgage interest. Yeah, I think that's that one covered.
Yeah. What if I want to sell a property in my investment portfolio? How do I retain as much of the profit as possible without paying tax?
Yeah, absolutely. So this one, it depends whether it's held in a limited company or in your personal name. If it's in a limited company, there's not much that's available in terms of reliefs or planning to avoid paying capital gains tax on the disposal. If you acquired it before 2015, I think it was, you can get indexation relief, which broadly means that your capital gain is adjusted for inflation. If you buy it in your personal name, there's something we could do. So if you're married, for instance, and you currently own all that property in your sole name, we could look to potentially give some of that property to your wife to make use of their capital gains annual exemption, which would shelter about £12,000 of the gain from tax, be it at 18 or 28%. Okay. So definitely speak to your accountant about that one and see if there's anything that can be done with regards to giving some of the property away to your spouse or partner to get that tax advantage.
Cool. So I'm buying a rent-to-rent company when I've already got an existing rent-to-rent company. Will I need to use separate bank accounts? And is there a way I can make one company the parent company? What else do I need to be aware of?
Yeah, so if you are buying a rent-to-rent company, the chances are that will already have its own bank account. As it's a separate legal entity, it's all going to have its own bank account. Everything is going to all be in the name of that company if you're just buying the shares of that. So with regards to having a holding company, yes, you probably should look at doing that, or should have done that before you purchased it, if it's not too late. The way to do that, you'd have to do something called a share-for-share exchange, where you would issue shares in the current company, the current SA company, in exchange for shares in a holding company, and then you'll just purchase the new company as a subsidiary of that. So it's definitely possible, but you need to act fast to ensure that you don't pay any extra tax on that.
Yeah, okay.
Or structure it so that it's a trade and asset sale. So rather than buying the company, you just buy its assets, so all of the units, so all the lease agreements, they'd be intangible assets, or all the furniture. You would buy that rather than the whole company, and that way you could just bring it straight into your existing company.
Right, okay. Cool. Can you claim capital allowance on serviced accommodation? If so, what sort of things are allowable?
Yeah, so absolutely you can claim capital allowances. So if you actually purchase the SA and own the unit outright, you can actually claim capital allowances on the integral features. So this is the stuff that if you were to lift the house upside down, it would fall out, kind of all the internal fixtures, all the piping, AC systems, all of that kind of stuff. You can actually claim a tax deduction for that. Usually it's anywhere between kind of 10 and 20% of the property's actual value that can be attributed towards it. If it's a rent to SA business, because you don't own the property, you can't claim that.
Right.
So you'd be able to claim capital allowances on any capital assets you buy, so whether that's TVs, beds, furniture, jacuzzis for the garden, all of that kind of stuff. We can claim capital allowances on that.
Yeah. And
then what that does is it acts as a 100% tax deduction in the first year if your annual investment allowance is available, which 99 times out of 100 for SA operators it will be. That comes straight off of your year one profits, meaning you get the total cost as an expense in your tax return. Yeah,
cool. How do I take money out of my property business to pay myself a salary?
Yeah, so great question. There's a couple of ways to do that. So if you're paying a salary, it depends on your other income. So if you've got another job, that might have an impact on it. But broadly, the best way is if you're a single shareholder director, pay yourself a salary of £8,632. The reason for this is it's below the national insurance threshold where the company has to start paying Class 1 secondary national insurance contributions.
Okay.
So that's the best amount. Top up with dividends or director's own amount account interest on top of that. If there's more than one director on the payroll, then you've had to claim something called the employment allowance, which shields some of that Class 1 secondary national insurance, which means that you could take a salary of £12,500 each for each of the directors on the payroll.
Okay, interesting.
Just to add to that, as it's almost into the tax year, if you do want to pay yourself, you need to act fast to ensure that you're not wasting your 1920 personal allowance, because you've only got a month to put the salary through, so it falls into this tax year. Other than that, if you've not used your personal allowance, it's lost.
Right, okay. So act quickly. Please can you explain Section 24 mortgage interest relief and who do the changes affect?
Yeah, absolutely. So the whole Section 24 mortgage interest changes, they affect unincorporated landlords, so people operating their own name in unincorporated partnerships. The changes broadly are the fact that previously, before the changes came into place, you could deduct all of your mortgage interest as a cost, just like you would anything else. So if you've got £1,000 rent, £10,000 rental income, £5,000 mortgage interest, your profit for tax purposes would just be the £5,000 that's left. However, that's not the case anymore. What happens now is what you don't get, or from next year onwards, you do not get any relief for the mortgage interest. Simply you get a basic rate tax credit. So on your tax return now, going back to that same example where you've got £10,000 rental income, that's what would show on your self-assessment tax return. And then you would get a basic rate tax credit, so 20% of your mortgage interest at £5,000, that would come off your final tax bill.
Right. Okay.
So for a lot of people who are higher rate taxpayers or claiming high income child benefit charge, it pushes it higher to those, they can be really worse off, and they can actually result in paying more tax than actually making from their property business, especially if you've got a higher leverage portfolio. So at the moment, there are a couple of ways to kind of get around it or negate a lot of the impacts and planning that can be done. One of these might be incorporating the property portfolio. However, this can be quite complicated. It's worth speaking to a professional about.
Next question. I'm a landlord that has a portfolio of properties in my own name with mortgages on all of them. How easy is it to transfer them to a partnership or a company, and what are the tax implications? Yeah,
so with regards to how easy it is, it's very easy. It's the tax implications that make it kind of infeasible or worthwhile. So if you transfer them to a partnership, it depends who the other partner is going to be. So if it's if you're a married couple and actually a partner, that's fine. We could probably get around any tax implications on that. If it's someone who you're not connected with and you're a business partner, for example, there might be some capital gains and stamp duty to pay on the transfer of assets into the partnership. Transfer into a company, if you go straight from your own name to a company, you're going to pay capital gains tax on the total gain that's left over. So if you've got your property portfolio, you paid £500,000 for it, it's now worth £1 million. You'll pay capital gains on that £500,000 uplift. There'd also be stamp duty to pay. This is where incorporation relief can be quite valuable, as per the Ramsey case, which broadly, rather than paying that tax now, it gets rolled over into the cost of the shares, and you only actually pay tax on that £500,000 when you sell the shares. And if you go via a partnership, so if you go from your own name to a partnership at LLP and then to a limited company, it's quite possible to avoid stamp duty and capital gains tax and have a completely tax-free incorporation.
Amazing. As a landlord or property investor, what expenses can I claim through the business? Yeah,
so you can claim absolutely anything where you feel quite comfortable as a valid business purpose. So whether that's training expenses, expenses going to view properties, maintaining them, absolutely anything. The only one that's specifically disallowed is business entertaining. So if you are going and giving estate agents boxes of donuts, and those kind of techniques, unfortunately that's not actually tax deductible.
I give the builders donuts.
Unfortunately that wouldn't be tax deductible.
Yeah. So only like the important things, not donuts.
Not donuts.
But so property training is tax deductible?
As long as it's updating existing knowledge. It's quite a grey area at the moment because there's no guidance on it or case or anything like that, because technically you don't need any training or education to become a property investor.
Yeah.
So at what point is it training and what point is it updating? But as long as you've read a couple of books on it and there's something you could justify that paying all these thousands and training is just updating that knowledge, that's fine, it's tax deductible.
Yeah, cool. What is a SIC code? What is it used for, and how do I know which SIC code to use for my property business?
Yeah, so SIC code stands for, I think it's Standard Industrial Classification Code, and really I wouldn't get too hung up about it. They have next to no impact on your business, yet everyone kind of obsesses about them. I'm not sure why. It's simply a government data gathering exercise, so they know what businesses in the country are doing what, and they use it for survey purposes. The only time it could have a slight tax implication is where you're looking to persuade HMRC that your property's a trading business rather than an investment business, and having the right SIC code there could have an implication. Okay. And again, for if you're running a service accommodation business and you're looking to use TOMs in the long run, then having a SIC code that indicates you're a tour operator might be persuasive, but in the short run there's no kind of downside to using the wrong SIC code, and it's very easily changed. So if you look on Companies House and type, I think there's quite a few ones. You've got tour operators. If you're looking to use TOMs, There's hotels or other established inns, I think it's called, if you're using a normal service accommodation. Management of real estate for a fee or other income basis is a popular one. And there's another one which relates to just standard property letting. But don't get too hung up about it. Ask your accountant if you need any help, and it can always be changed.
Yeah, so it's not like the end of the world if you choose the wrong.
Absolutely not. You can update it each year when you file your confirmation statement, but focus on just finding deals and making money rather than what your SIT code is.
Yeah, cool. If I'm doing rent to rent or rent to service accommodation, when do I need to register for that?
So it depends on what rent to rent you're doing. Because if you're doing rent to rent on a HMO basis, you would never need to register for VAT, because the provision of long stay accommodation, which HMO lets would be, is completely outside the scope of VAT. It's exempt.
Yeah.
Whereas for service accommodation, it is within the scope of VAT. So as soon as your turnover exceeds £85,000 on a rolling 12-month basis, at that point you should really be looking to register for VAT.
Yeah.
Well, you must register for VAT. A little bit before that, I'll have a chat with your accountant and see what can be done and what schemes might be available.
Cool. So, please can you explain TOMS? Which is better, TOMS or a flat rate VAT scheme?
Yeah, absolutely. So the first place to start really would be to explain what the standard rate VAT scheme is. So broadly, as soon as your income exceeds £85,000 and you must register for VAT, you must start charging 20% of your turnover on all your sales. If you previously sold a night for £100, you even now have to charge £120 if you want your profit levels to stay the same, or absorb the VAT, which means that you're taking a 20% hit on your profits. You can reclaim all your input costs, so all the costs of your linen, your furniture and things like that. You'll get some of that back, but ultimately, as you're making profit on your supplies, you're going to pay a bit of VAT.
Okay.
So what the TOMS scheme does is, rather than it being your nightly rate or your total revenue that counts towards registration purposes, it's your gross margin. So
Okay.
after the direct costs of making the supplies, to the rent you pay to landlords, sometimes for the ancillary services such as paying for your TV licence and getting Netflix in the building, things like that, that can be taken off. So rather than it being your £100 a night which you're charging, it might be just £50 a night, which is actually your profit on that. And that's what counts for registration purposes, and that's the amount you pay VAT on. So rather than paying 20% on £100, we'd now pay just 20% on £50, so you're instantly kind of almost half in your VAT bill.
Right, okay.
The flat rate scheme, that works in a similar way. Essentially, rather than worrying about all your input costs and things like that, you simply just charge a flat rate of VAT on your revenue. So for service accommodation, it's 10.5%. So if you're charging £100 a night, you'd simply pay 10.5% of that to HMRC each quarter. You can't reclaim any of your input costs, but it keeps it nice and easy. You've got a 1% first year deduction, so you only pay 9.5% the first year you're on the scheme. There's a lot less administration required. You don't need to get any kind of clearance or anything like that for TOMS. Which one's best? It depends on the cost you've got, the cost makeup of your business, so what your actual fees are, and ultimately what your ideal market is. If you're going after contractors or holiday makers, if you're going after contractors and corporate lets, because they're usually VAT registered, it's not an issue. You probably should be better off going on the standard rate or potentially the flat rate scheme. Whereas under the TOM scheme, you can't actually issue a VAT invoice, so they can't reclaim that back. In those circumstances, and you're going after the holiday makers, that's when TOMS might be beneficial.
Okay.
But ultimately, it's quite a complex area, and everyone should get independent professional tax advice on that area.
What trends have you seen in the last 3 years with your property investor businesses?
Yeah, so definitely over the last 3 years, we've seen a lot more people that have kind of made property a full-time thing and have got a lot more serious about it. Previously, before then, property was kind of a hobby or a second income or just kind of passive investment. Whereas at the moment, a lot of people are really starting to level up and grow quite aggressively with their property portfolios and run it like an actual business.
Yeah.
That's the biggest change we've seen, is people not looking at it as an investment anymore, but rather taking it and looking at it as a business.
What sorts of services will an accountant do for me, and how much can I expect to pay?
Yeah, so really an accountant can help you in every aspect of your business, starting from the bookkeeping, how you keep all your records, to getting a business plan together, setting budgets and financial plans, so you can see how your business is growing and measure it against expectation. So they can help with all of that. The most obvious role at the moment for an accountant really is to do your year-end stuff, so all the kind of stuff you have to do, you're going to get some pretty nasty fines and penalties, such as your limited company year-end accounts, corporation tax return, help file a confirmation statement. They're the 3 things that at a minimum your accountant will be doing. The cost for those 3, you're looking at about £100 a month, give or take £20 to £30, depending on where you are in the country and how qualified your accountant is, essentially. All the other stuff, it varies massively depending on your business. We've got bookkeeping services that start from about £50 a month. And it goes up to the hundreds depending on kind of what services you are and if you want a whole finance function. But I'd expect to pay about £100 per month to start off with. We, for that, include Xero and Receipt Bank, which are the 2 core apps you're going to need to systemize your finances. But yeah, from there you won't go too far wrong.
And how much do you charge to set up, say, like quite a basic limited company?
So just for a basic limited company, we charge £200. Simply because we have to do AML checks on all the shareholders and directors, and although actually setting up a company it takes about 20 minutes, it takes us at least kind of 45 minutes or an hour of somebody else's time to run through all the compliance stuff that we have to deal with in terms of our regulators. So that's what makes it a little bit expensive when people say, it's only a 20-minute job. There's actually a lot more that goes to it. But what I've actually done aside from this, I've set up an online course that goes through how to set up your own limited company. Goes through step by step, and we've had some great feedback on that so far, and that kind of debunks a lot of the myths and gives you that confidence that what you're doing is not wrong.
Amazing. I'll make sure I leave a link to that in the description bar below so you can check it out. What's the biggest mistake you see property newbies make, and how can we avoid it?
It's a great question. It's a tricky question. So I'd say the biggest mistake is ultimately probably getting your structure wrong and not realising where you want to go. So, for instance, we've had people that have combined all these different activities, such as deal packaging, rent to SA, or whatever it may be, all in one company. They've been trading quite successfully for a number of years, and they've just not thought about VAT. So this person had over £200,000 in income in that short amount of time from those activities, and they should have actually been paying VAT as soon as they went over 85,000. But they thought it was per different income stream, so they thought, as long as deal packaging doesn't go over 85,000, that's fine, as long as the service accommodation business doesn't. So they were kind of misled there, which resulted in them having a massive VAT bill to pay, which put them under massive financial pressure to kind of get that paid off.
So I guess that initial structure being right is so key.
Absolutely, from our point of view, and also just make sure you've got the right systems in place. So if you are looking to grow your business, make sure that you invest on day one to get the systems in place, rather than trying to implement it and tidy everything up and correct all the errors later on down the line.
Cool. Can I claim travel expenses to my rental property?
Absolutely. So you can claim travel expenses if you're using a car in a limited company that's owned. You can claim all of that. That's fine. If it's for your property business, you can claim the cost of your actual car if it's used enough. The most straightforward way is to claim travel expense at 45p a mile for the first 10,000 miles. This way you don't have to keep any receipts, anything like that. You just need a simple log of what property you went to, why you went there. You can do this on paper, Excel. There's some great apps like MileIQ and TripCatcher, which will help you there. MileIQ actually tracks your location, and then at the end of each day or each week, you can simply swipe left or swipe right, whether it's business or personal. And that's just a very easy way to keep track of all your mileage that you're doing for the business.
Cool. And how can a regular accountant become a property specialising one? What courses are there?
So there's actually no courses available. There's not really a set course on becoming a property specialist tax advisor. It's kind of just experience and getting involved with people who have been there and done that. So when I trained a good couple of years ago now, all of my kind of senior managing directors that we were working with, they've been dealing with property businesses, construction businesses for many years. So by being exposed to that and working with them, I picked up the knowledge. But in terms of qualifications, there's a chartered tax advisor examination, which I'm currently running through. We've got 2 exams left until I finish that one off. So that's the kind of elite standard that most people just become an accountant. That's great, you stop off there. But I've done that, and now we're going to the next level with the chartered tax advisor stuff. So the exam I just passed, I think 27% of people who sat it passed it, and you had to be a chartered accountant to sit the exam. So that kind of speaks as to how difficult it is. So that's going to be the best way, because the amount of knowledge you have to retain to sit those exams and pass it will give you a good kind of heads up into all the different property taxes that there are.
Yeah, cool. And is there any like apps or websites you recommend for people to like keep track of their finances?
Yeah, so the best one is Xero. We recommend it to everybody. It integrates with your bank, so rather than having to look for your bank statements, they just go straight into Xero. And if you've got a receipt bank, you can take a picture of all your receipts on receipt bank. That takes them over to Xero, and it pulls out all the information, so the supplier name, the date, the category and things like that, and it gets smart. So the more you do it, if it's kind of Peterborough City Council, next month you'll know that that's business rates.
Yeah. Okay.
So you won't have to do that again, and that will just automatically link up to Xero. So you just press OK, and that's all you've got to do to keep track of everything.
Yeah. Cool.
So definitely Xero and receipt bank. QuickBooks if you have to. It's a little bit cheaper than Xero if you're not using an accountant. But they're definitely the key ones.
Yeah, cool. Awesome. Well, thank you so much for coming on my channel.
My pleasure.
And you've got your own channel, so I'll make sure I leave a link in the description below so you can check it out. But yeah, thank you again. I'm sure that's helped a lot of people out.
Yeah, perfect. If anyone needs any help at all, definitely join the Property Tax Secrets group on Facebook. That's where there's a lot of people kind of commenting, answering questions, posting content. That's going to be the best place, really, if you've got any small questions from this, to get those answered. Otherwise, subscribe to my channel, please.
Yeah, cool. And there'll be links in the description bar to everything. But thank you guys so much for watching. Make sure you follow me on Instagram at Leah_Miller, and I'll see you next time. Bye.